Hi everyone and welcome to this week's UK Mortgage Market Insights. It's the week ending Friday, the 3rd of July 2026. How on earth have we already got halfway through this year? It's gone so quick. Anyway, this week's a big one, so let me tell you what's coming up. We've had a genuine flurry of lender rate cuts, so many that I'm going to use a phrase that I don't reach for lightly. We've got a proper mixed picture on swap rates. Mortgage approvals have dropped to their lowest level in over 2 years. Transaction numbers have dipped slightly too, though the annual comparison is doing some heavy lifting there. House prices depend entirely on which index you're looking at this week, and I'll explain why that matters. And Andy Burnham's housing speech this week has added a political layer on top of all of this. We're also going to be saying goodbye to one of the biggest names on the high street when it comes to financial services. And last but not least, at the end of this video, like always, I'll tell you what all of this news means for you and who can benefit the most right now. So make sure you stick around for that. Right, if any of this is going to be useful to you, please do make sure to subscribe to the channel before you forget so that you can keep up with this type of news every single week. Plus, it helps us more than you'd think. So, let's get into it. We'll look at lender rate movements first because this week has been relentless. Bank of Ireland cut rates twice in the space of 7 days. Atom Bank cut rates on their near prime products and increased the maximum loan to value available on near prime at the same time. So there's more room for people with a bit of credit history behind them. They also trimmed their prime range by 0.15%. April Mortgages, who I describe as the home of the long-term mortgage, have brought down pricing on their long-term fixes and their 100% mortgage products. Virgin cut fixed rates across the whole range. TSB made selected reductions. And then we've got NatWest, Principality, Santander, West Brom, HSBC and Leeds Building Society all trimming rates too. Barclays also moved marginally. Clydesdale cut rates generally, and for loans over £1 million specifically by up to 0.63%, which is a proper chunk if you're in that bracket. And LendInvest brought their buy-to-let pricing down as well. Now, I'll be honest with you, I've always been hesitant to use this phrase, rate war. It does get thrown about too easily in this industry. But when you've got that many lenders across residential, near prime, buy-to-let and higher loan sizes all moving in the same direction in the same week, it is genuinely starting to shape up that way. Whether it holds or not is another question, but for now, borrowers are the ones that are benefiting. Moving on to swap rates, and this is where it gets a bit more nuanced than the headlines might suggest. The 2-year swap sits at 3.920 this week, barely moved from 3.923 last week. The 5-year swap, though, has actually gone up to 4.002 from 3.957. So it's not a case of swaps falling across the board and lenders simply following them down. The short end is flat, the long end has ticked up a touch. What that tells me is this week's repricing has been driven more by lenders fighting for market share and by their own funding positions easing rather than a clean fall in the cost of money across the curve. And that's worth knowing if you're the sort of client who watches this type of stuff closely. Looking at criteria changes, there's not been a standout amount of news this week, but what stands out to me is Atom Bank increasing the maximum loan to value on their near prime range. If you're a client that's been turned away elsewhere because of a blip on your credit file, that's a door that's just opened a little wider. And it's always worth checking with your broker rather than assuming you're stuck with whatever you were quoted 6 months ago. We use Atom Bank quite a lot and we do have a lot of success with them. So moving on to the economic data, and there's a fair bit to go through. Bank of England figures show that mortgage approvals for house purchase fell to 56,200 in May. That's the lowest since December 2023, and well below the 6-month average of 63,300. Remortgage approvals fell too. They're down to 33,300 from 51,200 in April. Now, that's largely the lag effect of the Middle East conflict and the higher borrowing costs that followed it earlier in the year. Plus, what you'll also find is a lot of brokers who are also like me, and they get in touch with their clients 6 months early or when they see the signs of trouble to try and help clients out and get them onto better rates beforehand. So a lot of us were actually remortgaging clients earlier on in the year, sort of, early February, March time, before interest rates got too high. So a lot of that will also be reflected in these figures. But things are easing, and I can tell you from where I'm sat, that we are noticeably busier than we were over the last couple of months. HMRC's transaction figures tell a similar story. Residential transactions came in at 98,450 in May, down 2% on April's 100,440. Seasonally adjusted, that's still 17% higher than May last year, but don't get too excited about that annual figure because it's flattered by how weak April and May last year were when transactions had been pulled forward into March ahead of the stamp duty threshold changes. So the year-on-year comparison is really telling you more about last year's distortion than this year's strength. And then we've got the house price story, and this is where you need to pay attention to which index is talking. Nationwide numbers out this week show annual growth picking up to 2.2% in June from 1.7% in May. Northern Ireland is still the standout performer, they're up 8.6% year on year. The outer southeast is barely moving, just 0.1% growth. But here's the thing with Nationwide's data. It's measured at mortgage approval stage, not completion. So it's actually reflecting prices that were agreed 4 to 6 weeks earlier, more like April into May. So when you see that headline this week, you're not looking at a live snapshot of the market today, you're looking at a slightly lagged read and one that's still very much sitting inside the period of Middle East driven uncertainty rather than some clean pre-conflict baseline. But Rightmove's asking price data tells a completely different story. Asking prices down 0.6%, or just £2,000, taking the average asking price to just over £376,000. That's the biggest June drop in 14 years, and asking prices now sit 0.5% below where they were a year ago. Now here's where the confusion creeps in. Nationwide is measuring prices at the point of a mortgage approval, close to a sale but not quite a sale, and a few weeks old by the time it lands. Rightmove is measuring asking prices, what sellers hope to get, right at the start of the process. And those are two very different numbers, and the papers love mixing them up in the same headline. What I'm seeing on the ground backs up the Rightmove side of the story. Buyers are more savvy than they've ever been. This is a genuine buyer's market right now, and it's showing in what sellers are having to accept. That's also why I put every client that I speak to through a proper offer strategy before they put a bid in. I run a desktop valuation alongside the listing and build a three-pronged approach to the offer, and it's working. Clients are negotiating real discounts off asking price at the moment. They're not just shaving a token amount off. Now a quick word on politics because it's impossible to ignore. Andy Burnham, now been talked about as the frontrunner to become the next Prime Minister, gave a big speech this week setting out his housing reform ambitions, including changes to how property is taxed. Now, I'm not going to go over the top on it because we don't know the detail yet, but if you've followed this channel for a while, you know I've long argued that stamp duty needs reform, particularly for first-time buyers, and I recently posted a video on that. At the end, I'll put a link to that video here so that you can go and take a look, and make sure you leave your thoughts and ideas on what you'd like to see change, if anything, in the comments on that video. Now, away from the data for a moment because there's a piece of news this week that's really stuck with me. Lloyds Banking Group has confirmed that the Halifax brand is being retired from the high street after 173 years. Branches will be rebranded to Lloyds throughout 2027. Accounts will move across gradually, and Lloyds say that there'll be no changes from customers day to day. Same sort code, same account number, nothing that you need to do. But I'll be honest, this one's personal for me. I started my career in financial services with the Halifax. So seeing that name come off the high street after all these years is genuinely a sad part of our industry's history. It's not just a line in a press release. And it's not the first time either. People forget Lloyds did exactly the same thing with Cheltenham and Gloucester. C&G, another well-known building society brand that quietly disappeared from the high street back in 2009 after Lloyds took it over. So while Lloyds will tell you this change is nothing for customers, I think it matters more than that. Every time one of these names goes, we lose a bit more of what made the high street recognisable and a bit more of the character that this industry used to have. Not to mention competition and product choice, which is more important than ever to the consumer. I'd love to hear your thoughts on this Halifax move in the comments. Do you think it's a good idea? Do you think it's bad? Do you think it's sad? Do please let me know what you think. So what does all of this actually mean for you? Well, look, if you're a borrower, this rate war, if that's what it turns out to be, is working in your favour, and there's genuinely no harm in getting a fresh quote, even if you locked something in a few months ago. If you're a buyer, the Rightmove data backs up what I'm telling my own clients. You have negotiating power right now. Use it and do not be afraid to go in below asking with the right evidence behind you. My view on the market is this. The approvals dip is a lagging indicator of a difficult few months. It's not a sign of where we're heading. Activity on the ground really is picking up and lenders are competing hard for business. That competition only helps borrowers. So who benefits the most right now? Well, first-time buyers and anyone remortgaging in the next few months, because you've got falling rates and sellers who are having to be realistic on price at the same time. That combination doesn't come around often, but make the most of it if you are buying, because as the market picks up, so will house prices. So somewhere on the screen around me, you should see a link to that video that I mentioned, which is all about my thoughts on stamp duty and reform. Please go take a look at that and make sure you leave your thoughts and ideas in the comments section of it. That's it from me for this week. Like I said at the top, if you found this useful, please hit subscribe. It really does mean a lot. And also drop a comment, because this channel is for you and you can help to shape it. Let me know what you would like me to talk about in future videos, if there's any particular topics that are of interest. But for now, have a great week. Good luck to England on Sunday night, and I'll see you next Friday. Take care.